Welcome to Mark Arnold's Finance. This week is marking the week that the Fed raises rates. By how much, we can't know for sure, but we have a pretty good idea. But not only do we have that on our minds, we have a possible recession on our minds. So I want to cover this all today. I think it's very important. I have some very good points to make, and stay till the end because there's a very important thing that I want to bring up that I had in a prior video, but it's worth repeating. So if you're new to this channel, please subscribe. I'm very transparent. I'm somebody that's going to stay here. I'm not going to disappear tomorrow. I provide my opinions, my strategies. I'm growing, and so I think we can all grow together on this channel. So be sure to join, and let's get right into it. Right now, we're seeing headlines such as these, where it's saying that it's very, very unlikely the Fed can tame inflation without sparking a recession. There's things saying that the rate hikes will affect your credit card, mortgage, savings accounts. Also that they see the Fed hiking rates up to 5% as things are out of control, and also the possibility of today seeing a 75 basis point rate hike. So there's definitely a lot of fear out there, and we're seeing it in the headlines, we're seeing it in the stock market, people's reactions. So there's a lot going on. So I want to show this video of the CNBC analysts talking about the rate hikes, and then we'll discuss this a little bit more after.
It's a two-day Fed meeting, and you've got the Fed survey. I just don't see, no matter what the news is, it's exciting.
No matter what the news is. All right, well, why don't you come back on the other side of my delivery of the news
All right.
and give me your evaluation thereof.
Okay.
Because here's the deal, folks. The Fed expected to hike rates and reduce its balance sheet aggressively over the next 18 months. You know that. What you don't know is that most respondents to the CNBC Fed survey believe the process is going to end in recession. Here's the outlook for the Fed from this survey. 100% chance of a 50 basis point hike will be announced tomorrow. 90% chance they do it again in June, 50 basis points. 2.7 trillion in balance sheet reduction expected over the next 2 years and 5 months. That, by the way, is 6 months earlier to get to that point than the previous survey. And there's the terminal rate, 3.08, 3.1%, call it. That's expected to be reached in August 2023. That's 4 months earlier than the previous survey and 72 basis points higher than the March survey.
So as we can see from March, what was expected is a lot higher now. So I think people are freaking out a little bit. They're a little bit more on edge because right now we're possibly going to see a 50 basis point rate hike and another one in June. So I think it's more aggressive than what people were expecting. So imagine if we see a 75 base point increase today. I think that will create a really big reaction in the market. But a 50 point I think is somewhat expected, but just higher from what they were thinking back in March when they thought another 25 would happen. But we're expecting a 50 today. If we look at this, it is showing that the target rate over the next couple years will go up to a high of 3.08%, and then they'll start tapering down the rates again by the end of 2024. Of course, this is the future. We can't predict it. This is only what analysts are predicting, but we can only imagine that hopefully at that August 23rd, that's when inflation starts getting controlled and they can start reducing the rates again at that point. So not only do we have these rate hikes, we also have the Fed aggressively reducing their balance sheet. In fact, they want to run 2.7 trillion off its near 9 trillion balance sheet over the next 2 years and 5 months. That's a third of its balance sheet. That is very aggressive. So I think the Fed rate hikes are priced in the market, but I don't think this aggressive balance sheet reduction is. And so I still think we see some downside in the stock market, and that's something to keep in mind. Now, the other side of it is a recession. There's already been 1 quarter of GDP decline. If you get 2 quarters of GDP decline, that is the official definition of when a recession occurs. So we could see it happen as early as June. And there has been a poll that CNBC put out there where the majority, 57%, think that the rate hikes that happen today will cause a recession. 33% say it won't, and 10% are unsure. If you ask my opinion, I'm unsure because that's something that it's difficult to predict a recession. There's a lot of things that go into it. So I don't, I think it's more likely than not. I'll give you guys that. But the Fed is really trying to do a soft landing, prevent a recession, but it's going to be difficult. And we see quotes from people like Joel Naroff of Naroff Economics, who writes, the likelihood is that things will be worse and last longer than in most models, meaning that the Fed's ability to fashion a soft landing is highly unlikely. If it happens, it will be through sheer luck only. So that's kind of summing up a lot of the analysts and the economic pros out there that are putting forth their positions. It pretty much sums it up. They're all saying that it's unlikely that the Fed can do a soft landing. Keep in mind, inflation is at a 40-year high. That is almost a once-in-a-lifetime event. And so we have to keep in mind the severity of the inflation going on right now. And so it is going to be very tough for the Fed. I don't think that they're in a win-win situation. I think they're in a lose-lose situation. Either they raise rates higher than expected and people call out that, or they don't, and then people say, hey, you're not doing enough. So Powell has a tough job. That's all I got to say right now. So let's go into my own opinion. You know, a lot of this was from the research I did, but I think that there is more pain to come. I think that the Fed raising rates, the aggressive balance sheet reduction is going to contribute to a possible recession and a lot more volatility in the stock market. But we also have to factor in a few more things into the equation. We have the Russia-Ukraine conflict that is creating a lot of crisis around energy. A lot of neighboring countries like Europe and stuff are being affected, which we do business with. And so that's affecting us pretty heavily. We also have the very strict and aggressive China lockdowns. If you look into it, it's actually pretty sad what's going on, but that's creating supply chain snarls. And even Apple, one of the strongest companies out there, says next quarter is going to be affected by those lockdowns. So I still see volatility ahead. So the one thing I want to show you that's very important, I hope you take this into consideration. I did it in the last video, but I want to show this chart on recessions versus expansions. I think this is so important. We will see here that the recessions are the red areas below the 0%, and the purple areas above are the expansions. So the recessions in red are tiny little blimps on this history from 1950 to 2017 it goes to. The recessions happen on average for 11 months, and the average expansion happens on average for 67 months. Last one I read was about 69 months, but regardless, the expansions are powerful. And that is something to pay attention to, because right now, even if we're not in a recession, we are considered in a correction and a bear market, which are proven to be very exceptional times for investors to buy companies at more attractive valuations. And then following that are usually these really powerful expansions. So what do you want to be investing in right now in these red recession parts, followed by these large purple expansion parts? Instead of people selling and waiting, I think this is the time to be buying. I don't think you go all in, of course, because things could get much worse. We can't predict it. But looking at the charts of the stock market, we already have had some decent decline. So I think it's a very good time to start buying quality companies that can make it through a recession. And then when the powerful expansions hit for the following 67 to 69 months on average, you will benefit massively. So what companies am I looking at? Well, one company is Amazon. Amazon, do you think they will go out of business during a recession? Absolutely not. Highly unlikely. In fact, the opposite will happen. Once a recession does occur and is over with, the expansion part, I think, for Amazon is going to be humongous. So I am currently saving up for a share of Amazon. But you look at smaller companies, this is where you do have to be careful. Recessions can be a part of where smaller companies do go out of business. They can't, they don't have the cash flow. They maybe have too much debt. They're not big enough to really weather the storm. So be careful what you invest in. One of my smaller companies is Tattooed Chef. I think they'll be fine, but they're going to have a lot more trouble than a company like Amazon, Microsoft, or Apple that have the cash and the tools to weather the storm. So be mindful of what you're buying into, but I do think this is an exceptional time to be buying. Don't put all your money in because, again, we can still have quite a ways down to go. We just don't know. There's still a lot of volatility, As I mentioned, there's not only what the Fed is doing, but there's the Russia-Ukraine conflict, the China lockdown, so on and so forth. So I'm preparing to not go into safe companies, safe stocks. I'm going into those growth companies that I know during these expansion times are really going to benefit, because I rather invest in those companies for the 67, 69 months of growth versus safe stocks that'll keep me somewhat afloat for 11 months, right? Because those safe companies in those expansions aren't going to be as powerful as those high quality growth companies. And this is my opinion. Let me know what you think though. The other thing I want to kind of put out there, I was thinking about this. Usually a recession happens when nobody even expects it, right? But what have we been hearing about for the last couple months? Recession, 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 blah, blah, blah. So what I want to say is, with all this talk about a recession, I bet you companies are preparing. I bet you people are preparing. I bet you inventories are up. So if companies are preparing because of all this talk of a possible recession and the volatility, that could prevent a recession. We don't know. Or that can make it a very mild one. So that's another thing to keep in mind and put into the equation, is that, if you're expecting a lot, another crash or big dip, it might not happen because this recession has been cried out a lot. So companies might have been preparing. But on the other hand, you don't want to put all your money in because there could still be downside. Regardless, I think now is the time to start buying those companies you want, that you've had your eye on, that are quality companies that will benefit from that expansion after a recession, a bear market, a correction. And that's just my 2 cents. So let me know what you think. Of course, today I released this video early, so they'll be announcing exactly what the rate hike will be. It's expected to be 50 basis points. Regardless of what it is, I think the market will react the same way. There will be something to complain about, to say it should have been this or that. But regardless, your goal should be on the long-term sight of your portfolio, of your financials. And so just keep in mind that whatever volatility there is now, in 10 years, you'll look back and you'll probably wish you would have bought some of these companies that you're really wanting to buy. So I would focus your attention on the long term and not the short term. Drown out the noise, drown out the fear, and focus on what your strategy is, on what companies you're buying into, and just keep on analyzing them. Keep on, making sure that you are solid in your decisions, and you'll do fine. So anyways, with that said, hopefully we'll see how the market reacts. I expect some volatility after they announce it, which hopefully gives me an opportunity to get into Amazon at an even better price than it is now. I think it's at an excellent price now, but hopefully it goes down more for me. Regardless, you guys have a great day. We'll see you next time on Mark Arnold's Finance.